ready to rock and roll today. So excited to have you guys be here, and thanks for joining. And especially want to thank Christopher Jensen. He's the one that's going to be teaching the class today. So he is with Inspiro Financial and oversees the operation for Utah and for California. So excited to get to have Christopher to get to talk to you guys. If you're ready, Christopher, I'll just hand the controls over to you and let you take off. And I think we'll probably have a couple more joining, but I'll let you roll.
Thank you. Thank you. Good to, well, I can't see anybody, but I can see names.
I know, for some reason, I can't get them to turn on their cameras and stuff. So, but well, they're there.
Hopefully they're there. And great to have all of you and excited to be here with you. Welcome to Everest and the family. And I'd love to know how many of you are in Utah, how many of you are in California. If you can just put in the chat, maybe just put CA or UT or whatever, just so I know. Okay, Kelly, you're in Utah. Caroline, you're in Utah. iPhone, you're in Utah. I'm not sure who iPhone is, but that's great. Who else we got here? We got Josh. Josh is in Utah. Great. Ryan, Nicole, where are you guys from? And also Maywish. Maywish, I hope I said your name right. Maywish is in Utah. Okay. That's an all Utah crowd so far. Nicole, Ginger, I know Ginger's in Utah.
Nicole's in St. George.
Okay, great. Well, this will be, and we get Carolina. Is it Carolina or Carolina? Probably Carolina. I'm gonna go with. Well, it's awesome to be with all of you. This is a great, super fun class. Yeah, Carolina, great. It's a introductory class on mortgage lending. We'll have a little PowerPoint we're gonna go through. We're gonna talk. So I'm gonna share my screen with you here right now, if you all don't mind. All right. I'm gonna put it in presentation mode. There we go. So this is a class on the mortgage process. It's one of my favorite classes to teach. It's great if you are fairly new to real estate or fairly new to the mortgage world. It's great if you're an experienced agent and just want to get a refresher and want to know kind of how things work and the process and everything that we do. Because this is going to be something that you're going to want to be able to talk to your clients and understand how it works, because they're going to go through this. So we're going to go through this in a way that will help you understand kind of what your clients are experiencing. So let's talk about some of the things that you're going to learn today. All right. You're going to understand and learn what a mortgage actually is, how it works. What is it? You're going to learn what the basics are, the basic requirements to get pre-approved for a mortgage. So what do your clients go through? And you can help them as you pre-qualify them to see if they're clients that you want to take on. We're going to go through what the client experience is like in securing financing, both before and after you help them get under contract. And most importantly, you're going to learn, and I'm going to ask you to ask questions. I mean, a lot of this may be brand new. I may be talking really fast. It may go over your head to some degree. It's not rocket science, but I want to make sure you feel free to ask questions. I'd love to see your faces if you're comfortable with that. If not, make sure you unmute yourself at any time and ask lots of questions, because that's imperative that you do that to be able to learn. I just need to turn on my volume here a little bit more. There we go. Okay. All right, so an outline, we're going to talk again what a mortgage is. We're going to talk about how to prepare for financing. We're going to go over some definitions and terms. Mortgage lending, we love acronyms, all kinds of crazy acronyms, so we're going to teach you some of those. We're going to teach you about the different types of mortgage loans that are available. We're going to talk about some of the out-of-pocket expenses your clients can expect. Then we're going to go through the 4 steps that your client experiences as part of the lending process, that you understand and can kind of visualize what that is to help you be a better agent. And then obviously we'll end with some Q&A if we have any questions that we didn't discuss during the course of the presentation. All right, does can anyone tell me what a mortgage is? I'd love some feedback from any of you. What is a mortgage? You've heard that term, but what is it? Don't everybody speak at once.
I've found they're typically typing in their chat box. They don't like to unmute for some reason.
Gotcha.
A few will, but
that's okay. Well, I'll see if
a loan on a house.
A loan on a house. Excellent.
Anytime you're borrowing money.
What's that? Borrowing money?
I don't know if that's right or not. But...
Yes, that's right. It's a loan on a house. Sorry, my presentation. Borrowing money. It is a loan on a house. Let's talk specifically about what it is. Maybe there we go. Monthly payments from borrowers. Great. Yep. All those are great answers. From a more financial perspective, it is a loan for real estate, right? It's a loan that we secure to buy a house. So that was correct. It's a financial instrument. It's an actual contract. It's a piece of paper that is signed. That the technical term is called a promissory note. It's a note. It's a 8.5 by 11 piece of paper that someone actually signs their name to, promising to pay back money that they are borrowing. Now, this promissory note is very similar if you think of stocks. You know, back in the old days, before electronic trading was around, when you bought stock at, say, IBM, they sent you an actual piece of paper, right? A piece of paper, it's called a stock certificate, and it had your name on it, and it said you own this stock for $5, and it gave you so many shares. And that stock could be sold and traded and bartered back and forth with other people on Wall Street. And that's how the market worked. A promissory note is the exact same thing. If you think of a promissory note, it's just like a stock certificate. It's a financial instrument that is sold and traded on Wall Street in what we call the secondary or capital markets. That's very important to understand. That is where all mortgage loans go to live and die. All mortgage loans are financial instruments, traded, bought and sold. Doesn't impact your borrower, but that's what's happening on the back end. And that's where all mortgages are kind of controlled as Wall Street. If you have any questions as I bring this up, be sure to, I've got my chat box up now so I can pay attention. I see Carolina, yeah, it's a claim on the property. That's right. Any questions you have, put them in the chat box or just pipe up. Otherwise, I'm just gonna keep going. A mortgage is usually amortized, meaning the payment period is usually over 30 years, but you can have terms that go down in 5-year increments. I didn't put 25 on here, but you could do a 25, a 20, a 15, and even a 10-year mortgage term. But the majority of them are amortized for over 30 years. A mortgage payment is always due the first of every month. That's kind of an industry practice standard. And it's considered late if it's received after the 15th of every month. Do any of you have a mortgage right now? You could put in the chat box, yes, no. I'd love to know, just so I have an idea if you're familiar with some of these things. Now, preparing for a mortgage. Or mortgage financing, what is your client going to go through as they prepare for financing? Because that's such a critical part before they start to work with you. They need to understand and manage their credit properly. We're going to go into that further. Good. I'm glad to see several of you had mortgages. So you've gone through this process a little bit. But your clients really need to understand and manage their credit properly. And that's where a mortgage professional can assist them. They need to make sure, these are just some of the basics. They need to make sure they're maintaining a solid work history. And these bullet points, these are some of your pre-qualifying questions as you're prospecting and talking to someone before you get all hot to trot and start showing them properties and drive all over hill and dale to show them stuff. These are some of those pre-qualifying questions you're going to want to ask them yourself. Hey, do you have any idea of how your credit is? Have you had it pulled recently? Do you know what your score is? What's your work history like? Have you been working? We'll talk more about that. Have you saved any money, right? You need to get the best mortgages, you really need to be saving a little bit of money for a down payment. Now, there are loans that don't require that, but to get the best financing, you want to have kind of a down payment saved. So, hey, client, potential client, do you have any money saved? And number 4 is, gosh, they've just got to get pre-approved before you start anything. One of the biggest mistakes new agents, inexperienced agents make is they get so excited when they get, you know, not to be derogatory, but they get a fish on the line, right? And they just yank right away. They just, here's a million properties to look at. Here's a bunch of MLS listings you can show. Let me set up all these appointments for you to start looking at homes. And they completely forget about making sure their client is even qualified to buy a house. Your time is so precious. Your prospecting time, your lead generation time, your follow-up time, your contract writing time, all those time, your family time, all those things are so precious. The last thing you want to be doing is spending time with someone that just can't get a loan or is 6 or 12 or 24 months away because of credit issues. Make sure that you've got this, a big sticky note, wherever you prospect or work, that you are making sure your clients are pre-approved before you really dive in. And as an agent, you know, you want to be nice about it and say, listen, Mr. Susie homeowner, I want to work with you. You're great. But I want to make sure one of the things that I do is everybody I work with, I've got to make sure they've been pre-approved with a mortgage professional before I start working with them. That benefits you. It benefits me. I don't want to waste your time and I don't want to waste my time. And I want to make sure that we're on the same page. So when we start, we just really get going and work hard because I'm going to work hard for you. We got to make sure you're pre-approved. And that's where you got to get them with Inspiro, preferably, but where you want to get them pre-approved with the mortgage professional before you do anything else. Okay, let's go over some, any questions so far about that? Any experiences any of you have had where you kind of jumped the gun and it came back to bite you? All right, well, if you think of any, let me know. Let's talk about some mortgage definition and terms, some of those acronyms that I mentioned that we love to have and that you're going to hear as you're for those of you that are new, the things that you're going to hear in the lexicon between other agents. You're going to hear this. You're going to hear it from mortgage professionals, and you're going to want to understand what we're talking about. LTV. LTV stands for loan to value. Okay, before I do that, I had a question. How long does it take them to know if they are pre-approved? Great question, Carolina. The pre-approval process can be pretty quick. And we're going to go through what that is, what that process is. If your client's very motivated and gives us all the information, we can get them pre-approved in a matter of 24 hours, sometimes faster, because it involves getting an application from them and then some basic income and asset documentation. So they can get pre-approved pretty quickly. And we're going to talk about what that means, pre-approval versus pre-qualification, and the importance of both. So great question, but it can be quick so long as your client is responsive and gets us their stuff. If they don't and they drag their feet, then it just takes that timeline and extends it. Ginger Trask has a story that she wanted to share with everyone. Ginger, if you want to unmute yourself, we'd love to hear it.
Sure. This is a story. I had a buyer relocating from California who would fly in for the weekend with his wife and look at properties. And I kept asking him to get pre-approved. And he said he was already pre-approved with his credit union in California, but come to find out, they weren't able to do a mortgage in Utah. So it ended up being a big hassle because I just ended up, because of time constraints and the rush to get them in a property, and they'd flown all the way here. I showed them properties, got them under contract on a house. Then my lender here in Utah actually got everything she needed from the borrower and came back and told me that they were approved for $100,000 less.
Oh my.
So that created some problems. I mean, the other agent, the listing agent, wasn't happy with me. And of course, we had to back out on the purchase of that home.
Oh, those are heartbreaking stories, but kind of lesson learned, right, Ginger?
Oh, well, yes, and that's not my norm either. My normal mode of doing business is always to have a pre-approval before I show any homes. So
good.
This was a situation where I probably to have been stronger with the buyer, or not worked with that buyer.
Well, excellent. Thank you for sharing a few points about that. Number one, if you ever deal with someone that deals with a credit union, yeah, credit unions have to lend in the state in which they're licensed to lend in. That's kind of a credit union rule. So credit unions typically can't go across state lines. So that's number one. That's something that just so that you all know. Number two is when it comes to your pre-approval, don't just trust the piece of paper that the lender sends you. I would highly advise you call that loan professional that sent you the pre-approval and talk to them. We advise all of our agents, our loan officers, to do that once they send out a pre-approval, to call the agent and say, hey, I just want to talk you through this. Here are some of the nuances of this borrower who you need to be aware of. What kind of financing they're getting, how much money they have for down payment, any issues that could rise that you need to be aware of that are a little bit iffy right now with their employment or verifying their employment. Do they need help with closing costs? I mean, there's all kinds of things that the piece of paper is great that you want to get because you're going to need that with your offer, but you really want to spend some time speaking to that mortgage professional to make sure that you understand the ins and outs of the borrower, so you don't just look silly in front of the selling agent. Those are hard to have those kind of conversations when you spend so much time. So the question is, for people that come from California, and we are seeing lots of them, right? I mean, there's some reports that we could have 300,000 to 500,000 people moving from California to Utah over the next 3 to 5 years. That's just a huge influx. The question is, can people from California, can they use a bank from there, or does it have to be from here? Banks and credit unions are different. So most banks have national charters. You got to find out whether it's a national bank or a regional bank, but most banks fall under FDIC rules, which means they can lend in any state in the country. And most do, not all of them, but most have that capability, where credit unions do not. But the thing that you want to remember here is lending in real estate is a local sport. It's a local game. Meaning if someone's moving here and looking at a house, it's not going to benefit them to have an agent in California to help them with houses here. They need a local person on the ground. With their financing, I highly suggest that your clients use somebody local. Lending in California, we lend in California, we lend in Utah. Those are our two primary locations. I've been doing this for almost 30 years and I've lent in every state in the country. Lending is completely different from state to state. The nuances, some of the regs, some of the guidelines, it's different. How escrow is handled, how closing is handled, how title is handled, how appraisals are handled. It is a local sport. And when we see all the time, big national banks, number one, you don't get customized personal service because you're just a number. You're just someone that they're just talking to, and your clients aren't going to have that same intimate experience. But number two, they don't have the local expertise, and you're going to run into issue. So I for sure would advise your clients, if they come here or from out of state and they say, well, I've been pre-approved with my bank in California, wherever, say that's awesome. But as your real estate professional, I highly advise you speak to somebody local, because you're going to get better terms, better service, better value, better speed, and I'll be able to communicate with them. And we have to act kind of as a team throughout this process. Bata, did you have a question? Or Ash Christian in Centerville? I just saw you popping up. I didn't know if you have any questions. Let me know if you do.
No, I'm okay, but thank you.
You bet. Well, thanks for that, Ginger. Really appreciate you kind of bringing that home and the importance of getting pre-approved. Okay, so we've got loan to value. What a loan to value is that is the percentage that someone is borrowing versus what a sales price is. So if a sales price, let's say, for example, just for an easy number, is $100,000, and a borrower is going to get a loan for $80,000 and put $20,000 down, that means their loan to value is 80%. An $80,000 loan for a $100,000 purchase, their loan to value is 80%. So you'll hear that a lot, LTV, because that's very critical in lending, about what someone's LTV or loan to value is to determine what kind of loan they can get and what kind of interest rate they get. LTV. APR, annual percentage rate. You see this all the time in any kind of a financing contract you get into, whether it's with mortgages, student loans, car loans, credit card financing, doesn't matter. Annual percentage rate is not, let me emphasize again, annual percentage rate is not the interest rate the borrower secures that determines what their payment is. That's their interest rate. The annual percentage rate is a government formula, and in my opinion, one of the worst things they ever did because it's super confusing. But it's something that is required to be disclosed. It annualizes what their interest rate is over time based on the cost they're paying for that loan. That sounds like a lot, but what happens is basically if someone's interest rate is 2.5%, there's some costs involved with that loan, and the APR takes those costs and amortizes it over the life of the loan and then reflects it in the form of an interest rate. So while someone's interest rate on a mortgage may be 2.5%, their APR could be 2.9%. The whole purpose of the APR was to kind of show you that mortgages and any kind of loan is not free, that there are costs associated with it, whether it's interest or other fees up front that they're going to pay. But it's very confusing to clients. It causes all kinds of questions. But you need to know that is not their interest rate that determines their payment. Usually your title or escrow officer will do a great job explaining that, but it's something that you guys will see on any kind of financing you do, whether it be home, auto, student loans, or whatnot. Okay, PMI versus MIP. Private mortgage insurance versus mortgage insurance premium. These are terms that are related to a mortgage insurance premium that the borrower has to have and pay for if they do not put 20% down when they buy a house. So again, anytime someone buys a house and puts down less than 20%, they are required by regulation to have either private mortgage insurance or mortgage insurance premium. Those terms are interchangeable. They mean the exact same thing. One just has to do with conventional loans. One has to do with government loans. And we'll talk about the difference between those two types of loans, but they're the exact same thing. And this is an insurance policy that the borrower is paying for to not insure themselves, but to insure the investor or lender in case they were to ever default on their mortgage. The lender or investor has to have some insurance in place per government guidelines that if that borrower ever were to default and were foreclosed on, it allows them to recoup some of those losses. And that's in a policy that the borrower has to pay anytime they put less than 20% down. And the amount of that payment depends on what kind of loan they're getting, how much their loan amount is, all kinds of factors. But it's an extra part of a payment, and it can be anywhere from $50 a month to several $100s a month, depending on a bunch of factors. So MIP or PMI, private mortgage insurance premium. DTI, or debt to income ratio. We're going to show you what that means here in a few slides, what a debt to income ratio is, because that is the key determining factor in what someone can qualify for. And it basically is determining how much debt do they have in relationship to their income. But we'll go into that in further detail. But you'll hear that's one of the key factors in getting someone pre-approved. Hazard insurance, kind of a funny name, but hazard insurance or homeowners insurance or fire insurance, whatever you call it, this is insurance that does protect the homeowner in case of loss, theft, damage, fire, windstorm, whatever. Everyone has to have insurance on their home. They pay for it in their monthly payment every month. But a term that you hear about is called hazard insurance. Points or discount points. These are fees that some lenders and particularly credit unions charge the borrower to get a loan, in addition to just the normal cost of a loan. It's called an origination fee, a discount point, points. There's all kinds of words that you can use, and they mean different things, but they typically, in this case, involve if you want to try to get a better interest rate, you're going to pay extra money to get the lower rate. If today's rate's 2.5%, if you want to get 2.25, you may have to pay 1 or 2% of your loan amount to get that lower rate. That's called discount points. We usually don't encourage that because it's very, very, very expensive, but some clients like it. ARM stands for adjustable rate mortgage. Most mortgages are fixed loans, meaning the interest rate stays the same over the life of the loan. It never changes over 30 years. But ARMs, adjustable rate mortgages, they will adjust after a certain number of years, typically after 5 or 7 years, then the interest rate will adjust annually thereafter. Well, why would somebody want that? The reason they would want that is because an ARM interest rate is usually a little bit lower than a 30-year fixed rate. And if someone knows they're not going to be in their home longer than 5 to 7 years, why would they pay extra interest for no reason? So these used to be very, very popular 10, 15 years ago. But because the last 10 years we've been in these historically low interest rate environments, right now we're in that right now where rates are the lowest they've ever been. People typically just go with a fixed rate rather than an ARM because the difference in the two rates is not very much. An LE versus a CD. These are things you need to be aware of. A loan estimate versus a closing disclosure. These are documents that we have to, per regulation, send to your clients to outline the terms of their loan. At the beginning of the process, the LE, and then at the end of the process, the CD. And we'll talk more about what those are, but that just tells the client and informs them through disclosure what the cost, the terms, the payment, the interest rate of what their loan's going to be. LE and CD, we have to send them this twice to them throughout the loan process. An origination fee. An origination fee, and this is what I mentioned before I misspoke, something that most credit unions charge, but most mortgage banks like Inspira Financial does not charge. We're a direct lender. We don't charge origination fees. The origination fee is usually a percentage of your loan amount that the financial institution charges your borrower to do the loan. And it's usually 1% of your loan amount. So if you're borrowing $300,000, that's a $3,000 fee that the lender is charging you. Very few lenders charge this, but most credit unions and a lot of banks are starting to do that. When I say bank, I'm talking about like a Chase, a Wells Fargo bank. In Inspira Financial, we're considered a mortgage bank, meaning we're a direct lender. We don't do checking, savings, car loans. All we do is mortgage financing. But the technical term for Inspira was a direct lender or mortgage bank. We can talk more about what that means, but that's kind of the highest end of mortgage financing that you can be. Escrow, this is two definitions. And since we don't really have anybody from California, I'll still let you know, but escrow means two different things in lending. Number one, escrow is a process, meaning if you're in California and you're gonna get someone under contract, you open escrow. It's an actual process with a title and escrow company where you give them their earnest monies deposited with escrow. They get a copy of the contract and you open escrow, meaning that's the process that you go through from the time you're under contract until you close on the loan. That's a California term. We don't open escrow in Utah. But escrow, the second part of escrow applies to both states, and that's actually a dollar amount. An escrow is an account, like a forced savings account, that is set up by the mortgage company for the borrower to pay for their property taxes and their homeowner's insurance. And we collect money up front at closing to help pay for those things for them. That's called an escrow account. And that's something that's in every kind of loan that's out there, that someone has an escrow account. Those of you that have mortgages likely have an escrow account, and you can see it on your statement, how much is collected for that every month. Locking. Locking means when we actually secure the interest rate, and we, like the term means, we lock it in. It does not change. So no matter what happens in the market, the interest rate's going to stay the same, and they're not going to lose it. So if we lock in a loan today at 2.5%, if the market goes up, down, sideways, does not matter. Their rate is secure on the borrower. They don't have to worry about it anymore. It's very important that we do that right away. PITI. This is the four parts of someone's payment: principal, interest, taxes, and insurance. PITI. FHA and VA. These are two government agencies that issue loans. They stand for Federal Housing Administration and Veterans Administration. Fantastic, fantastic loans, particularly for first-time home buyers on FHA and for anyone that has VA benefits on a VA. If anyone that you deal with is a veteran, we want to try to get them into a VA loan because the interest rate's a lot better than normal loans, and there is no down payment requirement for a VA. They can get into a loan with 100% financing. Okay, let's go right into now what these different types of loans are, since we just introduced FHA and VA. Let's talk about the different types of loans that there are. And again, any questions, speak up. Any experiences you have, personal experiences, frustrations, whatever, you just speak up either through the chat box or through this, unmute yourself. Someone's asking if I can send the presentation out. Absolutely. I will send it. I'll send it out to Russ, and Russ can forward on to anyone that would like it. Okay, let's talk about the different types of mortgages. There's only a few types. The main type of mortgage, which accounts for probably 75 to 80% of all loans that are ever done, is called a conventional loan. A conventional loan. All loans are governed by government agencies back in Washington, and they set the guidelines and the standards that we all have to follow. And when I say all, it doesn't matter if it's a direct lender like us, if it's a credit union, a private bank, a tiny mom and pop mortgage broker, it doesn't matter. We all have to follow the same guidelines. And those guidelines apply to these types of loans. But the types of loans has to do with who is really underwriting the loan, who is insuring the loan. And a conventional loan, I like to use the term, it's a private market loan, meaning it's not a government issued type of loan. And as I mentioned, most loans are conventional loans. There are loan limits for conventional loans, and all these loan types have different loan limits. The national loan limit for a conventional loan is kind of a funny number there, $548,250. That means that you can borrow up to that amount in any county in the state of the United States and qualify for a conventional loan. But if you need a loan for $550,000, that is now no longer considered a conventional loan in some counties, and you'd have to get a different type of loan product. Now, some counties are considered high cost counties. For example, most counties in California are high cost counties. Salt Lake County is considered a high cost county. Summit and Wasatch County are considered high cost counties. And what that means is they extend the loan limits a little bit in high cost counties. So in Salt Lake County, for example, the loan limits actually is a little over $600,000. So you could actually get a loan up to $600,000 and still be considered a conventional loan. In Summit County, that loan limit's over $700,000. But there's only 3 counties in the state of Utah that are considered high cost counties. That's important because once your loan is not considered a conventional loan, to qualify is much harder. The interest rates go up, the down payment requirements go up, and your loan options are reduced. And so we really try to encourage our clients, and if they can, to keep their loan amount at that conventional loan limit, because things totally change from a lending perspective if you go above that. Now, sometimes you can't. You don't. If you're buying a huge house, you don't have that option. But that's what a conventional loan is, and it's a private market loan. The next kind of loan is an FHA. We just talked about FHA. Rather than privately underwritten, it's federally underwritten and insured. And FHA has various loan limits per county for every county in the United States. And there is really no rhyme or reason to it. Well, there's a formula for coming up with it. But I gave you an example here that you can see for all of us in Utah and Salt Lake County, the Salt Lake County FHA loan limit. And this isn't the purchase price limit. This is the loan limit, what they borrow. In Salt Lake County, it's $453. In Utah County, it's $439. But in Davis County, it's $646. Makes no sense. We don't get to control that. Why is Utah County less than Salt Lake County? Why is Davis County $200,000 more than Salt Lake County? Homes aren't more expensive up there. Now there's military bases up there, and that could have something to do with it. But it's FHA loan limits are county specific, and that means you can't get an FHA loan if you're trying to borrow more than $453,000 in Salt Lake County. That's important because FHA loans are a little easier to qualify for than conventional loans. The interest rates tend to be a little bit better, and the down payment requirements are less. So that's why I mentioned before, FHA loans are the loans that usually first-time home buyers qualify for, but they're limited on the amount that they can borrow. VAs we talked about, those are for veterans only. They're really, and the other nice benefit of VA, besides that it's 100% loan, they don't have to have any down payment, is that there really is no real loan limit. There's no guideline for that, which is great. Veterans should have all the benefits that we can give them. If you have someone that's a client that says they qualify for VA benefits, we need to make sure and verify that, because sometimes they don't, even though they said they served. There's a certain document that we have to get from the VA to tell us whether they actually do qualify for full VA benefits, because if they don't, they can't get a VA mortgage. So if someone tells you they qualify for that, again, that comes back to making sure that they get pre-approved and that we have verified that they actually are eligible for VA status, so you're not, again, wasting your time showing them properties that they have no business buying. Okay, so what happens if your loan amount is over that $548,250 limit, or whatever the high balance limit? High balance is the term for those counties where you can actually go a little bit higher, like Salt Lake County, up to $600,000. So what happens though if you need an $800,000 or $900,000 loan because your client's buying $1 million property? Well, in that case, they have to get what's called a jumbo loan. And jumbo loans are much, much more difficult to qualify for, as I mentioned. Higher rates, stricter requirements. They require a much larger down payment, and they just take more time. So that's called a jumbo loan. Non-QM stands for non-qualified mortgage. These are your non-traditional, we call them portfolio loans, meaning they're not really underwritten or insured by a private market or the federal government. those are individual banks or credit unions or financial institutions that have their own type of specific portfolio products. For example, a bank statement product where we're using someone's bank statements to qualify them. That's very non-traditional. These loans there are very few, this year we've done last year we did maybe 2 of all the 1,000 loans we did, maybe 2 of them were non-QM loans because again, they're not very good interest rates. They require usually 20+% minimum down payment, sometimes 40% down payment. They're just not your traditional product, but they're out there. And then again, we talked about fixed rates and adjustable rate mortgages, the difference between the two, and we primarily see fixed rates. Any questions about types of mortgages before we go on? The last thing about mortgages we want you to be aware of is these 3 entities, Fannie Mae, Freddie Mac, and Ginnie Mae's. If you've never heard of them, they're kind of bizarre. They may sound like a cookie brand or some weird name. These are government-sponsored agencies. These are the agencies that dictate and control all of the guidelines for all these loans above. This is who we deal with directly. They are the policy and the guideline makers when it comes to lending. Fannie Mae, Freddie Mac, Ginnie Mae. For a question, for the VA, are these loan values visited for changes? How often? Sorry. For the VA, does not matter if they are working. No, they do have to work. And any kind of loan that we get, whether they're a veteran or not, they have to have a job and be working to qualify for a mortgage. So that's a fundamental requirement. You can't not be working. The only time you cannot be working is if you're retired and you receive retirement income or disability benefits or military disability benefits or Social Security benefits, and that's enough income to qualify you, then you do not have to be working. But otherwise, most people have to have a job because we'll show you why in a minute, why a job is so imperative. Another question said, how often are the loan limits revisited for changes? And the answer to that is annually. Every year. Last year, the conventional loan limit was $510,000 and it went up $38,000 this year. They revisited every year. It's based on cost of living indexes. It's based on appreciation values. About 10 years ago, the loan limit was $417,000, and it was $417,000 for about a decade. It did not change. But in the last 5 years, the loan limits have changed every single year because costs are going up substantially, and we need to increase those limits to be able to get people into houses with conventional loans. So yes, back to the question about jobs. Yes, retired people are okay to qualify, but they still have to have income. And we have to see what that income is, either through pension, Social Security, retirement, whatever. They still have to have income to be able to qualify for a mortgage. When in the year do the conventional loan limits or the loan limits change? They always change the very first of the year. So we're notified in November and December for loan amount changes that are effective January 1st. So this new increase went into play on January 1. Are VA loans available to the active military as well as retired military? Yes. VA loans are, and there's a form that's called a DD 214 that tells us what their eligibility. So oftentimes if you're active military, but you just started active military, you may not qualify. You have to be in the service so long before you get full benefits. Or if you were only in the military for 18 months or 2 years and now you're out of it or retired or not doing it anymore, you may not qualify for full military benefits. It just depends on your level of service. If you served in an active war, you get benefits faster than if you didn't and were on reserves. So there's all kinds of things with the VA, but most veterans qualify, but we wanted to double check and make sure. Great questions. All right, let's talk about some of the out-of-pocket expense your clients can expect. They're going to ask you as an agent, hey, what's going to cost me to buy a house? How much do I have to save? What do I need to prepare myself for? Number one is, as I mentioned, other than a VA, and most loans require a down payment. We'll get to that in a minute, but most loans require a down payment. On conventional loans, the minimum down payment is 3%, but that has strings attached. Typically on conventional loans, people put 5% down as a down payment, 5% of the purchase price. On FHA, the down payment is only 3.5%. So it's much smaller. Again, why most first-time buyers go FHA. But the more down payment you have, the better, meaning you get a better interest rate, you have a lower payment, your mortgage insurance premium will be less. It's easier to qualify. And that's just one of these qualifying questions that you're going to want to have when you talk to people is if someone has very, very small down payment, you just need to know going in, it's going to be a little bit more dicey to get them pre-approved. And it's more likely that things could arise throughout the process versus that someone says, oh, I have $100,000 to put down. That mitigates the risk. That's a four-letter word that you want to have in your brain when it comes to lending, R-I-S-K, risk. Everything about lending is risk. All the requirements, all the guidelines, everything we do, all that are put in place are all about risk. What's the likelihood that this borrower is going to default or not make their payment? That's all lending cares about. They don't care about, the color of their skin, how much money they make, where they went to school, who they know, the kind of house they're buying. None of that matters in lending. Those are obviously important things from a personal and relationship standpoint. But from a lending requirement, it's all about how risky is it to give this person a loan. And the guidelines are dictated based off historical data. There have been hundreds of millions of loans that have been done in this country in the last 50 plus years since our modern lending system was created. And the statistics just show how likely someone is to go into default and not make their payments based on the lending requirements. And that's why they are what they are. Okay, if a person can prove the VA certificate of eligibility and get a check from contraction company, that person can qualify for a loan. Yeah, they likely, if we get a certificate of eligibility that shows that they are eligible for VA financing, that's only step one to make sure they qualify for VA. But we still have to go through all the other requirements that I'm going to go over here in a minute to show whether they qualify. It's not just enough to be a veteran. That just gets them on the train tracks to qualify. But as far as moving that train down the track, they have to actually qualify for a loan. And that is a much more extensive process that we'll go over here in a minute. And that applies to any type of a loan, the qualifications that we're going to go over. So the biggest out-of-pocket expense for a borrower is their down payment requirements. Number two is closing costs. Mortgage loans are not free, unfortunately. There are some fixed costs that are associated with getting a loan. Most of them are just standardized fixed costs that are not negotiable because they're not fees that the mortgage company has anything to do with. They're title fees, recording fees, state and county fees that you have to have. And most of those costs are fixed, so it doesn't matter whether you're borrowing $100,000 or $1 million, they're going to be the same. But there are a handful of costs that are variable based off the borrower's loan amount. So the higher the loan amount, the higher the closing costs on some of those things. And that's something that we provide the borrower and let them know when we get them pre-approved about an estimate of what those closing costs are, or what they're going to be. That's number two. Number three is some inspections and an appraisal. As an agent, you're going to highly advise that your client get a property inspection once they go under contract to make sure the home's in order and not falling apart. Those cost $300 to $500 depending on who you use. We don't need that for the loan, but it's the best insurance policy that your client can get because the last thing they want to do is buy a house and find out it's got $50,000 of plumbing work that they didn't know about. So that's something they have to pay upfront in advance to an inspector if they want to do that. The appraisals cost anywhere from $525 to $575, depending on the type of loan they're getting for an appraisal. On purchases, most companies require the borrower pay that. We have to have an appraisal done. I shouldn't say that. 9 out of 10 times we have to have an appraisal done. Every once in a while we get an appraisal waiver, but on purchases it's not as common unless someone's putting a huge down payment. But 9 times out of 10 we have, in purchase transactions, we have to by guideline get an appraisal. And those cost a little over $500. Most companies require the buyer to pay for that up front. Inspiro Financial does not. We do not require they pay that. We will take that risk and pay for them up front, and then we'll collect the payment from the borrower at closing as part of their closing costs, which just alleviates a little bit of risk to them and it alleviates some upfront out of cost expense to them. It's kind of a little benefit to Inspiro. So inspections and appraisals. Now, all of these, I don't know if you can see my arrow as I'm kind of moving on the screen, but all of these things up here, these three things can all be gifted, meaning if your borrower does not have this money saved, they don't have a down payment, they don't have money for closing costs, they don't have money for appraisals and whatnot, those things can be gifted to them from a direct family member. So grandma, grandpa, a parent can gift them the money for the down payment. And we see that quite often in first-time home buyers. Homes are super expensive. Young couples have a hard time saving $10,000, $15,000, $20,000 for a minimum down payment closing cost requirement. And we often see funds being gifted to them. So one of those questions, as we talked about, pre-qualifying questions to your borrowers is, hey, do you have a down payment? No, I don't. Okay, well, do you have a family member, a close relative that can gift you the down payment? Oh yeah, my mom and dad said they're going to give us 50 grand to buy a house. Okay, then you know you're okay. If they say no, then the only other option is what's called a DPA. That's down here. Down stands for Down Payment Assistance Program. There are some programs that are state specific where someone outside of VA, that where a borrower can get a loan for no money down. So it's basically 100% financing. It's a first and a second mortgage. In Utah, the most common one is called Utah Housing. You may have heard of it. There's another program called Chinoa, but they are down payment assistance programs where we secure a first and a second. The second mortgage is the down payment requirement, but it's given to the borrower in the form of a loan. Those programs, we do them a lot. We don't push them because, number one, the interest rates aren't as good. It's not as great at terms. It costs a little bit more in closing costs for the borrower. And we want to try to get them the best program and terms available. But for some that don't have any other option, a down payment assistance program like Utah Housing is a great loan. But there are income and loan restrictions. You can go to the Utah Housing website to see what those are. But there's an income limit, meaning someone that makes $150,000 will not be able to qualify for Utah Housing. There's income restriction limits based on how many people are in their household. And that's a whole nother topic we can go over. But just know that there are those types of programs. And that's one of the things we analyze with your clients when we get them pre-approved, is whether that's something that we need to explore as a down payment assistance program. Okay, now any questions at this point before? What we're going to do now is we're going to go through the 4 steps that your client experiences as they come to us to get pre-approved, what that is like, what they're going to experience, and the timing and the process. And this is all in an effort to help you know that they're good to go, because there is a difference, as you see there, getting pre-approved versus a term that's called pre-qualified. Many companies use these terms interchangeably, but there's a vast difference between the two, and I'll tell you why. What is a pre-qualification and what is a pre-approval? A pre-qualification is a client takes an application online, enters in all their information, and based off of the information they provided, we then go in and see whether they meet the guidelines and requirements for a loan. We don't verify anything that they put. We take their word for it 100%. And that's all we do is get the application, and whatever they're telling us, I make $55,000 a year. That's what we're using as their income. That's a pre-qualification. Most lenders and banks, that's all they do, is they take an application, review the application, and then send you a pre-qualification letter. But hopefully you're seeing that, well, wait a minute, you're trusting what the client is saying. You're not verifying anything on a pre-qualification. Yeah, that's what a lot of companies do. We at Inspiro and most good companies take it to the next step, which is a pre-approval. A pre-approval means we not only take the application, but now we verify what the client says. So if they say they made $55,000, they need to prove to us that they actually make $55,000. And they're going to do that by providing bank statements, tax returns, pay stubs, W-2s, all their basic financial information. We want to see those to verify what they say is true. And why do we do that? We have a term that says trust but verify. We love clients, but clients have a tendency to exaggerate. Do you make $55,000 or is it $52,000 and change? Because that could have a difference. Do you make $15 an hour or is it $15.45? Because that will have a difference in whether they qualify. And clients don't know what we have to look at, the nuances to get someone pre-approved that's entailed. They may say they've had a job for a year, but it's only been 6 months. We have to verify all those things because all those impact whether someone actually can get a loan. So we trust but verify. So a pre-approval takes that information to a whole nother level to really make sure, yes, we can verify it, we've reviewed it, and they are good to go. And that's what that mortgage professional's job is to make sure. So we only issue pre-approvals because we don't want you wasting your time. Because what happens a lot is someone that's pre-qualified, they think they're okay, they get under contract, we start the train down the track, and then now once we start to verify everything, oh, they don't make $55,000 a year, they only make $45,000 a year. And it's a part-time job, which is different than a full, all this stuff. And now everything comes unraveled and they can't qualify for a house. So you want to make sure that when you deal with Inspiro, you're automatically going to get it. But if you deal with anybody else, that they are issuing a pre-approval and that you speak to that loan officer and say, did you verify their income and asset documentation to make sure that this is actually what they do? And this is actually what they're able to qualify for, because it's a huge difference. There's even a third level that we can go to that's called a credit approval. And that is where we actually have an underwriter look at the file and make sure that everything we verified is accurate. We will do that on a case-by-case basis. A lot of companies won't, but we do that on a case-by-case basis if there's some really funny, hairy stuff about the file. Most of the time, 9 times out of 10, our loan officers are experienced enough. We know whether someone's going to qualify based off the information and documentation they've provided. But every once in a while, we need to have an underwriter look at it. Okay, someone had a question. How much credit score can qualify for Utah housing loan at minimum and maximum credit score? Again, that totally depends. So she's saying, what kind of credit score do you need to qualify for Utah housing? Totally dependent on the borrower. They have minimum scores of about 660 on Utah housing. How much they qualify for depends on the borrower, their income, their assets, their credit, all kinds of stuff, which is what we're going to go through and talk about. A single parent who co-worked 1 to 4, who worked one company 4 to 5 years. Yeah, if someone's worked at the same job, we'll talk about job history here in just a minute, Bada, and kind of go over and answer your questions. Great questions though. Okay, what are the things that we kind of look at? Number one, we look at credit score. The higher the credit score, the better. Credit scores range from 350 to 850. There are 3 credit bureaus that we get scores. So everybody has 3 credit scores. In mortgage lending, we throw out the high score and the low score, and we use the middle score for qualifications per guideline. We like to see scores in the high 700s. For conventional loans, anytime your score dips below a 740, your interest rate's going to go up. So every 20 points that your credit score goes down, the interest rate goes up about 1/8%. So someone who has a FICO, it's called a FICO score, or credit score. Someone who has a credit score of 760 is going to get a much better interest rate than someone who has a credit score of 660 on conventional loans. The higher the credit score, the better. The minimum credit score on conventional loans is a 620. That's just a federal guideline. You can't get a conventional loan if your credit score is below a 620. On FHA, you can go down to 600. And your interest rate isn't impacted as much on FHA with lower credit scores. Again, another reason why first-time home buyers use FHA more than others, because FHA is more forgiving. So number one, we look at someone's credit score. That's such a huge part. They've got to have a credit score. They've got to have some credit that we can analyze. And when it comes to their credit score, these are the things that determine what someone's score is. This is the syllabus. This is the grading scale. This is how. Why is my score 800 versus someone that scored at 600? This is why. Number one, 35% of someone's credit score is based off of their payment history. Do you pay on time? Makes sense. You borrow money, you lend money. Do you pay those debts back on time? Yes or no? And that accounts for a full third of someone's credit score. So someone that always makes their payments on time, is never late, they're going to get an A+ in that part of their weighted grade. The second thing is, how much do you owe? How much debt do you carry? It's okay if you carry debt, but this is really about how much debt you owe on your credit cards, okay? Credit cards, believe it or not, account for a full 30% of your credit score. And that doesn't mean you shouldn't have them. It means you absolutely do have to have credit. If someone that does not have any credit cards at all, because sometimes that's what their parents teach them, don't have credit cards, they're awful. They're not going to maximize 30% of the credit score, because credit cards are a way to see how someone manages kind of free money given to them. Here's a credit card that's got a $10,000 limit. How do you manage it? Do you blow it all? Are you maxed out on it? How do you treat it? And so 30% of your score is based on how you manage your credit cards. You need to really have about 3 credit cards active to optimize 30% of your credit score. But how much you owe is the critical factor on that, meaning you do not want to be maxed out on your credit cards. Maxed out means owing more than 70% of the credit limit. So if you have a credit card with a $1,000 credit limit and you owe more than 70%, that means you're maxed out from a credit standpoint and your scores get hammered. Even if you've never been late on your credit card, if you're consistently owe more than 70% of your credit card limits, your scores go down substantially. If you owe more than 50%, they go down less. You want to maintain a balance on your credit cards of less than 30% of the limit, to have the very, very best score possible. And you do have to have some to maintain that. This is some of the things that we review with clients to make sure they understand it. We'll get someone that very often that has credit, they're 45 years old, they've had credit forever. They've never, ever been late on anything, but they have about 5 to 10 credit cards, which is excessive, and they're maxed out on every card. And instead of having a score in the high 700s, they have a score in the low 600s because they have so much credit card debt. Why, you say, why is that? They've never been late. Well, the reason is that they are one slip and fall or one accident away from total financial catastrophe, because the first thing that people don't pay on and when they have financial trouble is their credit cards. People will always pay on their mortgage. They'll always pay on their rent. Next, they'll pay on their auto loans. Credit cards are at the bottom of the list. And if you're maxed out on your cards, you have no wiggle room to live off your cards in the short term if you've had an accident or you lose a job. So maxing out your credit cards is absolutely terrible for your credit score. And this is part of the education that we give people. Someone asked, what are student loans? What are they considered? Student loans are considered just regular accounts. They're not considered credit card accounts. They're considered just like they are. It's called an installment loan. So it's just like a car loan. Student loans have to be factored into someone's credit profile, even if those loans are in deferment. But they are not viewed like credit cards. They're viewed just in the normal payment history cycle. It's a good question. So payment history, the amount you owe, the length of credit, meaning how much time have you had credit. If you're younger, you're just not going to have a super higher score because you've only had credit a few years versus someone that's 50 that's had it a long time. Credit's all about risk. Again, that 4-letter word. And the more credit history we have, the more likely we are to determine whether you're going to pay something back. So we want to have lots of history over time and lots of types of credit. But that leads us to number 4. Anytime you open and close an account in the short term, it hurts your score. So we want to see how much new credit you have. Have you opened or closed accounts in the last 24 months? How many accounts do you have? And then number 5, what type of accounts do you have? You're going to have a better credit score if you have a mortgage, a car, a student loan, credit cards, a boat. I mean, all this kind of stuff. The more diversity you have, it allows the credit bureaus to see how likely you are to pay something back. If you've only had one credit account in your entire life, that's not very much history to go off of, and you're not going to have a very high score. So this is a really fast overview of credit and what the score, how we determine those scores. I can give you all kinds of information, but we go over this with all of your clients because they're likely not going to, when we help them, it's not going to be the only house they buy, and we want to set them up for future success and teach them the credit score game, because it is a little bit of a game that you have to understand. Any questions about credit scoring in general? So this is the first thing that we look at when it comes to getting someone pre-approved and qualifying for a mortgage. Number 2, to some of your questions, we look at someone's income. We need a full 2-year history, no job gap. Someone has to have a 2-year work history to qualify for a mortgage. Now, if they were in college and just recently graduated and are now working, we can count their college as work history. But otherwise, they have to have a 2-year history. Someone that was unemployed for a year and then just got a job a month ago is not going to be able to get a mortgage loan. They've got to be back working again for at least 3 to 6 months before we can help them to show that they have some continuity in their job history. And then they still have to have shown they worked for at least 2 years over the last 5 to 10 years. So we always have to get their income history to show what they've been doing for the last 2 years. When we ask for their income documentation, this is again part of getting pre-approved versus pre-qualified. These are the things that we're going to ask for. We're going to ask them for their last 30 days of pay stubs. We're going to ask for their W-2s, their 1099s, their K-1s. We're going to ask for their federal tax returns and all their schedules, all the pages. If they're self-employed, we're going to ask for their corporate tax returns and a P&L statement. We're going to know more about them than anybody else. We have to really dive down deep to get this information. When it comes to someone's job history, it's okay if they change jobs, meaning it's okay if they've had 3 or 4 jobs over the last 5 to 10 years or the last 2 years. That's fine. People move up and get better jobs. That's okay. They have to be on the new job at least 30 days before we can qualify them, meaning if they get under contract and they change jobs in the middle of being under contract, they just shot themselves in the foot and are going to have to wait 30 days because we have to have 30 days of pay stubs when someone changes jobs. But it's okay if they've changed jobs to get a better job. We just don't like to see gaps. We don't want to see they worked and they were 6 months off and they work for a year, then 6 months off, then work for a year. That's inconsistency and a little bit of a risk. But it's okay if they've changed job and went one from next to the next to the next. That's totally okay. So these are the basic income things that we're going to get to qualify someone. We're going to look at their credit history, and we're going to look at their income history and require all this stuff to verify it, trust but verify, to get them pre-approved. Now, let's come back to this debt to income ratio. And this comes back to some of the questions some of you posed in the chat box about, well, how, do they just automatically qualify if they're a VA or something else? No, they have to qualify from a debt to income ratio. A debt to income ratio is what determines how much of a loan someone qualifies for. I'm going to show you an example here of what that means. But what the definition of a debt to income ratio, DTI, is someone's total grossly month debts divided by debts and payments divided by their total gross income. So let me show you what that looks like as an example. Let's say someone makes $10,000 a month. They have a $120,000 a year salary job. They make $10,000 a month. And they have $2,500 a month in monthly obligations. Let's say that they have $1,000 in credit cards, student loans, and car payments that are showing on their credit report. And then the house they want to buy is going to cost them $1,500 a month. So a grand total of $2,500 a month in obligations that they have to pay. 2,500 divided by 10,000 is 25%, meaning 25% of their gross income is going to go out the door every month for their house payment and any other debts that are appearing on their credit report. That's a debt ratio, 25%. Hopefully that makes sense. That's just simple math. That determines how much someone qualifies for. So if, in this example, if someone wanted to had a house, they had $1,000 of debt on their credit, and they wanted to buy a house that was $5,000 a month, that means their total payments would be $6,000 and their debt ratio would be 60%. They are not going to qualify for that. We got to get a lower house. We don't like to see debt ratios. We like to see debt ratios below 40% as much as possible. We can go between 40 and 50% if they have really good credit and have compensating factors. But 40% is kind of that margin that we like to keep it at if we can. If they go above 45 to 50%, they just won't qualify for certain types of loans at all. They can't. That's a deal breaker. So that's why when we get someone that's how we get someone pre-approved, is we plug in a purchase price that gives us a payment, and we say, do they qualify for this payment? What's their debt ratio? Nope. That means we got to lower the house price 10,000, another 10,000, another, until we get to the point where this is the maximum amount and they can qualify for a house. And then that's the number we tell you as the agent. They qualify for a $250,000 house or a $500,000 house. This is how we come up with that number. It's their debt ratio. And the debt ratio is based off of their income versus what their monthly payments are going to be. Does that make sense? And their payment that we're calculating, again, has to do with their principal, interest, taxes, and insurance, and mortgage insurance if they have it, in addition to all their debts on their credit report. And this is those three things: credit, income, and debt to income ratio. Those are the three pillars of getting someone pre-approved. Those are the things that we go through and analyze and look at, and why we want to see whether someone qualifies. And that's another reason why you want to get pre-approved versus pre-qualified. A lot of times when someone gets pre-qualified, the lender never pulls their credit and has no idea what kind of debts they have or may not have, or that they had a bankruptcy, or that they have child support they have to pay because that's on a credit report, or if they have tax liens or judgments which have to be satisfied. There are all kinds of things that a credit report shows that we want to make sure that we address to see if it disqualifies them from financing. All right. What are the documentation items that we're going to need in addition to things we've talked about to get someone pre-approved, or once they are pre-approved as we start the loan process? So we talked about all their income documentation, pay stubs, W-2s, etc. But we're also going to get asset documentation, meaning if they say they have $15,000 in a down payment, we need to verify that, trust but verify, to pre-approve them. So we're going to ask them for 2 to 3 months of bank statements, investment account statements, retirement statements, to verify that they really have that. Because the last thing we or you want is we get to the closing table and guess what? Oops, we didn't have enough money, right? We have got to verify up front that they have enough money for their down payment, whatever things they need to do to close on this loan. So we're going to ask for that up front. If they've been divorced, we're going to ask for a copy of their divorce decree. That's really critical, particularly if whoever we're dealing with, husband, wife, doesn't matter, if one of them is obligated to pay child support or alimony, because child support or alimony is just like a debt that we have to count against their debt ratios. So in the previous example where someone had $2,500 a month in monthly debts with their house payments and credit, what if that was a gentleman who also was required to pay $1,000 a month in child support or alimony? We'd have to add that onto their debt load, and now instead of their debt ratio being 25%, it'd be 35% for that extra $1,000. We also need to see if someone was awarded a house. Very often we're talking to a wife who's just divorced her husband, and she was awarded the home, but the home, it was in the husband's name, and we have to refinance it, and we need to get that information. So a divorce decree is critical because it gives us all kinds of information. Bankruptcy, if someone's had a bankruptcy within the last 4 to 7 years, it may make it so they don't qualify. It depends on the type of loan that they're getting. And it depends on what type of bankruptcy there is. There's 2 types of bankruptcies, Chapter 7 and Chapter 13 for personal. There's also a Chapter 11 if it's a business. We have to see what kind of bankruptcy they had to see whether they qualify, because there's a waiting period. If you had a Chapter 7 bankruptcy, which means you kind of wiped all your debts clean, you cannot get a conventional loan for 7 years after that bankruptcy was discharged. Your hand gets slapped pretty severely in those cases. So we need to see if they've had a bankruptcy. We need to see if they've had a property foreclosure, if they've had a short sale, any of that kind of stuff. We have to get that up front. Then obviously we have to make sure that they're either U.S. citizen, permanent resident alien, or have a work visa and a right to be here. We cannot give loans to foreign nationals that don't work and live here. You can't get loans for those types of people, or if they're illegal, we can't give them. Now, DACA, we can give loans to. DACA meaning people that were brought here because their parents moved here when they were young. Most DACA recipients have work authorizations, and that's a federal card that they have. We can give them a loan, that's fine. That just changed recently. But we got to make sure that they qualify from a residency standpoint. So this is the documentation items we're gonna look at and get. Now, once we've done that, we're gonna send you that pre-approval letter. We're gonna tell you what's happened, that they're good to go, and give you the parameters. And now you kind of come into play, and they're going to start house hunting. And this is where we give you the baton back, and you start showing them houses. This is all you. Step 2 of the process is all you. And we're here to help you and guide you through that process. You want to make sure you have that pre-approval letter. It's absolutely critical. The client or you can call us anytime, day or night. Hey, we found this house. They want to know what the payment is to see if it's going to meet with their budget. Great, we'll get all the details of the house, and we'll update the pre-approval and let you know whether they qualify or not. A couple things during the house hunting process, once you get them under contract, right? When you're starting to write that contract, there's a couple things that you need to be aware of to make yourself look good and to make sure things are smoother. And so some rookie mistakes that you want to avoid. Make sure that you review the rep sheet in a few items. In section 1.2 of your contract, which is the first page of your contract, is where you include items in the contract, meaning I'm buying this house and they want to include the swing set and the hot tub and the barbecue in this purchase contract. That all sounds great, but we're going to tell you, we're going to require you remove those items when we get it, because we cannot have personal property items in contracts in lending. Anything that's kind of detached from the home or separate, you need to have a separate bill of sale if you want to include that in the contract. Because if we get it, we're going to require you to take it out, and any lender will, because we cannot have personal property as part of the contract for the overall value of this purchase price. We can only lend on the value of the house. Now, you can include certain things like appliances because they're standard, they come with it. Or if the hot tub is permanently affixed to the property, but a separate playground or an above ground pool, that kind of stuff, you cannot include, and we're going to require you to take it off. So just keep that in mind, because that just means you got to go back to the seller agent, have them sign an addendum, removing it, and it kind of is a waste of time for you. So just upfront, no, do not include personal property items in your contract. Number 2 on that is closing costs. You can request that the sellers pay closing costs on purchases. You're gonna have to have an addendum to do that. But it used to be very common that a seller, particularly when it was a buyer's market, that a seller would agree to pay $3,000 or $5,000 of the seller's closing costs and prepaid items for taxes and insurance. It's not nearly as common today because we are in a massive shortage of inventory and a total seller's market, and sellers just aren't willing to do that very often, but it still happens. And so if you negotiate to get the seller to pay for some closing costs, you just got to make sure you outline and spell that in an addendum so we can see it. Next thing, when it comes to contract deadlines, section 24 of your contract, this is where you really need to be in sync with your lender, with your Inspiro loan officer or whoever you're dealing with. Don't just write in standard dates, meaning, okay, we're going to have the inspection done in 7 days and the financing deadlines in 21 days, and we're going to close in 28 days. Those are kind of standard that most agents put in their contracts. You need to speak with your loan officer because there may be instances where those kind of deadlines cannot be met. And you're just setting yourself for a little bit of heartache if you try to do that. For example, 6 months ago, if someone was trying to close in 21 to 28 days, we would have told them you need to extend that contract out because we're in the middle of the biggest financing boom in the United States has ever seen. And it's taken 30 to 45 days to get deals done. Now we can make an exception sometime, but that's where you got to have that communication. Or maybe this client is getting a Utah housing or a Chinoa loan, and those loans or a USDA loan, which take 45 days. It has nothing to do with us. We're dealing with a government agency that's just going to take longer, and it will not be physically possible to get the loan done that fast. You need to be aware of that up front because that has a huge impact on the deadlines that you put. You want to communicate and coordinate with your loan officer to make sure that you are putting in deadlines that can actually be met from a lending standpoint. So that's super critical that you get together with them. Also, you need to know what kind of loan they're doing, because if they're getting an FHA loan, there's a special FHA addendum you have to have in your contract that you have to get the sellers to sign in addition to the standard contract. So again, this goes back to why a real estate agent loan officer relationship is so critical, and why Inspiro is specifically here as the affiliate lender for Everest. This is our focus, and primary focus is you, in making sure that you have all the information and tools you need to get your stuff done in a timely manner. So we want to make sure that you're aware of that to set yourself up for success, not for some heartburn as you get people under contract. Okay, under contract, you get the contract signed, delivered, agreed upon. Now you pass the baton back to us. And this is where we take it to the finish line to get the loan documentation and everything that needs to be done. What does that involve? There's processing of the loan. We've got to get going on the processing and the paperwork. Mortgage lending is the most regulated industry in the country by far. It's over-regulated, in my opinion. And that's a direct result of the huge housing crisis that happened about 13 years ago in the late 2000s. We had a huge financial crisis in this country that was a lot because of speculative housing. As a result, the government stepped in, way overstepped, and we have massive regulation, massive guidelines. There are literally 1,000 points of light that we have to check off and do that you don't ever see on the back end to make sure a loan works. And there's just massive documentation, and everything has to be perfect or it's not compliant. So in processing, we're going to gather all kinds of documentation. You've seen what some of that is today. We're going to lock in their interest rate, make sure that's taken care of. They don't have to worry about the rate changing. We're going to send them out their disclosures. Disclosures are initial sets of documentation that everybody gets that buys or refinances a house in this country. They're federal forms that just has your borrower's information transposed onto it. And we do it electronically 9.5 times out of 10 because it's fast and it's efficient. We have a fantastic mobile app that we send stuff to clients, or if they don't like it, it comes to their email and they can log on any kind of device that allows them to e-sign all their paperwork. That mobile app we have, it's called Pronto, can be co-branded to you. So you can share it with your clients and that you're up to date and informed of what's happening all along the loan process. It's a great tool where you can go in and put in mortgage loan amounts and get interest rate and payment figures. And where your clients can actually get pre-approved. So you can be instrumental in the pre-approval process by sharing the mobile app or sharing the link and saying, hey, go here, get pre-approved, that automatically gets sent to Inspiro, and they're going to respond to you really quickly. So it's kind of a nice tool. But we're going to send out e-disclosures for borrowers to get going on their loan. We have to get initial disclosure signed for us to legally be able to proceed with the loan once they're under contract. We're going to order an appraisal. That takes some time. That's the biggest time crunch under a contract, because appraisals are through independent third parties called appraisal management companies that the federal government set up. We have to order an appraisals through these independent, non-biased agencies. We don't get to pick who the appraiser is. It's randomly selected by the appraisal management company. And then they have to get in touch with the listing agent to get in there. That's the thing that takes the most amount of time, because it's out of our hands, it's out of your hands. We're leaving it up to an appraiser to get in touch with an agent on the other side of the contract to get that done. We have to get that done. We have to order the title policy with the title company of your choice that you want to use. Hopefully that's a North Star Title. We're going to order the hazard insurance, the insurance on the property in processing. We have to order 1 million third-party verifications with the IRS, with their employers, with the federal government, to make sure they don't have any, they're not criminals. I mean, there's all kinds of background checks we have to do for everybody involved. And we're going to order any other additional documentation based on that borrower situation, because every single loan is different. No two loans are alike. That's something to remember. No two borrowers are alike. No two situations are alike. And while there are standard guidelines and qualifications, everyone is going to be tailored and tweaked for their individual situation. We have to document it accordingly. And we are going to review. The name of the game is details, speed, service, and compliance. We've got to review everything to make sure that things are done properly, because otherwise we run into snags along the way. Okay, once we get their documentation sent back to us, the disclosures, we've gotten all this stuff back, the appraisal, the title policy, all the stuff, the loan gets submitted to underwriting. The underwriter is the person that's legally authorized to review the file and clear everything to make sure it's approvable. And there's 4 C's of underwriting that the underwriter looks at to determine whether someone qualifies to the guidelines on whatever type of loan they get, whether it's conventional, FHA, VA, does not matter. And all these guidelines and all these things we gather are applicable to any and every type of loan that we get. The first thing that underwriter looks at is credit. They analyze the credit. Does the borrower meet the qualifications from a credit standpoint? Is their credit score good enough? Number 2 is collateral. Collateral is the actual appraisal, the purchase contract, the title policy. Is everything in order with the appraisal? What happens if the sales price is $250,000 and the home only appraises for $240,000, right? Well, in that case, either you can renegotiate, or if the seller is not willing to renegotiate, the client's going to have to bring in an extra $10,000, because we have to go off the lesser of the two, purchase price or appraised value. What if the appraiser did a poor job and didn't use the correct comparables? The underwriter is going to address that. That doesn't happen very often, but it can happen. What if you did put in personal property items on the rep sheet? The underwriter is going to require you to remove it. The underwriters, they're the ones, again, that are licensed and authorized to make sure that all the documentation we have meets the guidelines, and they are reviewing it. Think of them like an auditor from a financial perspective. They got to make sure that everything is in order. Credit, collateral. Number 3, compliance. There are all kinds of investor and regulatory requirements that we have to meet. Did we do the loan in the proper order, in the proper sequence? Did we disclose properly? As I mentioned, over-regulated. There are many things that we have to do in a certain way. For example, we have to send disclosures out within 3 days once we have their contract. We have to send the closing disclosure 3 days before you can close, and we'll go over that in a minute. There's all these time sequences that are involved in lending. We can't close a loan any sooner than about 8 to 10 days by law. We can't, even if we could, we wouldn't be allowed to close it any faster than that. So there's all kinds of compliance things that an underwriter is going to review. Then lastly, capacity. Capacity means, does this borrower have the ability to pay back the loan based on their debt to income ratios, their credit, their income, etc. So those are the 4 C's: credit, collateral, compliance, capacity, that an underwriter looks at, and they're the ones that review the file to sign off on them to make sure the loan is legit. Once the underwriter's reviewed it, we've cleared off all the conditions, we've satisfied all the guidelines. The underwriter puts their stamp of approval and says, yep, you are cleared to close, move forward. And that process usually takes 3 to 4 to 5 weeks, just depending on the borrower, to get us to that point once you've gotten them under contract. It now goes to closing and funding, meaning these are the people at the end of the assembly line that are issuing the final documents that you're going to sign to the title company. They're the ones that are funding the loan. And everything we do, just so that you know it, in Spiro, everything is in-house. Everything I've described, from origination to loan officers to processing to underwriting, it's all right here in our Cottonwood Heights location. Because we are a direct lender, we control everything from start to finish. It's our money. It's our people. We don't send it off to someplace else, to another state, to another company. We do everything right here. And when it comes to closing and funding, we begin working on closing the moment the underwriter issues an initial approval. So before they give us the final approval, when they give us the initial approval that says, yeah, it looks good, but you got to get this stuff for me before I'll give you a clear to close, we start working on closing. And we start doing that at least 7 days before the scheduled closing date. And what we do is we're going to issue the CD, the closing disclosure. We told you that closing disclosure is the document that tells the borrower their interest rate, their loan amount, the closing costs, their payments, all that kind of stuff. And by law, we have to issue that to them a minimum of 3 days before they can close. We do it way before that. We do it at the time of initial approval. But the CD with us is issued at the time that the underwriter initially looks at the file. And it has to be issued no later than 3 days before you can actually sign at the dotted line of the title company. Once we have gotten it cleared to close and we've been granted and you've decided a closing date and time, you'll get that scheduled. We'll help you get it scheduled. Maybe you'll get it scheduled with the title company so that we know exactly when you want to sign, when we want to have the wires, the funds wired, and when they want to have the loan recorded with the county. As I mentioned, we have to wait 3 days from the time the CD has been issued until you can close. So if we issue a CD on Monday, the earliest we can close is Thursday, because Monday, Tuesday, Wednesday is 3 days. The next day is Thursday, we could close. And so that's really important if we have a tight deadline or whatnot, that everybody understands that. And that's not something that can be waived. That is a federal law that we all have to kind of follow on the 3-day rule. I'm going fast now, so make sure and stop me if you have any questions. Do you sell your loans after closing? Great question. Let's talk about that real quick. Inspiro Financial is a direct lender, which means, as I mentioned, we handle everything from start to finish. We deal directly with Wall Street. A mortgage loan consists of 2 items. It consists of the promissory note that we talked about, that piece of paper that is sold and traded on Wall Street like a stock certificate. You will never know who actually owns your loan, the promissory note. You will never know who that is because your loan is bundled with a bunch of other loans and traded on Wall Street. So you'll never know when your loan is bought, sold, and traded. That you don't get notified of that. But that's something that happens on every single piece of mortgage loan that happens. I don't care who does the loan. The promissory note is sold into Wall Street to an investor. But the second piece of every loan is something called the servicing rights. The servicing rights is who actually sends you your monthly statements. So those of you that have mortgage loans, whoever your loan you're making your payments with right now, they don't own the promissory note. They are just the service provider and have the rights to sell the servicing. And servicing can change from time to time because servicing rights has value just like the note does. People buy and sell the servicing rights because they get a fee for doing that. So those of you that have mortgage loans, the company you're making your payments to, they get a monthly fee from whoever owns the loan on Wall Street. They get a monthly fee to collect your payment, process your payment, pay your property taxes and insurance when they become due, and answer any customer service questions you have. But they do not own your loan. Okay, they just have the servicing rights. At Inspiro, like all companies, the note always gets sold into Wall Street and has little impact, doesn't matter, has no impact on the borrower at all. The servicing, that's the part that has impact to the borrower. And that's the part you're talking about. Do you sell the loan? That's really what you're referring to. And at Inspiro, we retain the servicing of probably 90% of our loans because there are some loans we cannot retain servicing on. So there's some jumbo loans we can't retain servicing on. Utah Housing, those down payment assistance loans, we're not allowed to retain servicing on. Those have to go to certain companies to do that. But most our conventional FHA, all that stuff, we retain the servicing. So that means people are making their payments to us or to our service provider that we use. But that doesn't mean that we keep it forever. And no company will can ever promise that. Even if they try to promise you that, it's a false promise because servicing rights, while we try to maintain it, sometimes we decide to sell those servicing rights because it's important for us to do that. We can make extra money on a profit side to do it. We don't do it very often, but it can happen. But 90% of the loans we don't. We keep them, but doesn't mean we don't reserve the right to sell them at some point in the future. And that's the case with every mortgage company out there. So you've all that have had mortgages, you've likely had your loan transferred. The servicing's been sold 1 or 2 times after you got your loan. That's normal. I know it's a little bit of a pain and a headache, but there's nothing we can do to stop that. A credit union or bank can't stop that either, even though they may say they do, they don't. It doesn't change the terms of your loan, doesn't change the payments of your loan, it just changes who you make your payments to. But when we close loans, we keep the servicing rights 90% of the time, which is nice because that way you know your client's not going to have to deal with that very much. Great question. Once we send our funds to title company in advance of closing typically. So in that same example, let's say you wanted to close a loan on a Friday. We'd already sent the CD days before. We'll likely send the funds to the title company on Thursday so that's there, and then just not authorize them to release those funds until a certain point of the process. But at least the funds are there and there's no waiting on those funds. Most companies do not do that. We like to fund in advance. Funds can be dispersed, and the note, that promissory note can actually be recorded, because that promissory note, in addition to being sold on Wall Street, is recorded as a recordable document with the county. So that note, we allow that note to be recorded and the funds to be dispersed to the seller only after all parties have signed all their documentation and everything's been electronically sent back to us to review to make sure it's been done properly. Once that's happened, then we allow the title company to release those funds and get the loan recorded. And that happens really fast. Very rarely do we have a delay in that. The only time that we have a delay is a title company didn't sign the documents right, or they missed a form that the sellers or buyers were supposed to sign, or someone was out of town. This happens every once in a while. You know, you're closing, but they're in California on an unexpected business trip, but they can't be here. That means we've got to have a mobile notary sign for them and overnight the documents back. There could be a few delays like that, but we try to mitigate those as much as possible. And so we know in advance what's going to happen so we can account for that. Then the keys, that's it. That's the process. Then you get the keys from the seller, and happy days, and everyone's thrilled, and it was a great process, and the clients have moved into their house. And that's the best day of all, is when you're able to give keys and have a satisfied client that had a great experience. You need to know that, you know, at Inspiro, we take very seriously our role as the financial advisor and mortgage lender on this transaction. We have tremendous experience in what we do. Even though our company is relatively new, historically speaking, the people that work here all have 10, 20, 30 years of experience. We have hundreds of years of experience in our operations staff, and our loan officers. And everything we do is a reflection on you, right? We understand that. When you refer or are dealing with anybody, your client is going to feel like this is a team. And if they don't have a good experience with their lender, it comes back on the agent, right or wrong. It just does, right? And so in lending, it's all about speed and service and that experience for the client. Were they educated? Were they communicated well? Did we tell them facts up front? Did we give them proper advice? Did we hold their hand when necessary? Did we keep them calm when necessary? Because this is it's a stressful occasion for them. This is the biggest purchase they're ever going to have. And we want to make sure that they feel good about it, and confident about it, and trusting about it. And we are a reflection of you in that respect. And you need to know that we take that role very seriously in making sure that your clients have that positive experience, because you want them coming back. You want referrals, you want repeat business. And that doesn't happen unless they have a fantastic experience throughout the lending process. Now, listen, there are going to be hiccups along the way. That's just real estate, right? That's just part of lending. That's part of purchase transactions. Something's going to happen, and that's okay. We all expect that when we know it. We want to stay calm. We want to be the voice of authority and the voice of reason to make sure that it's expected that's going to happen. And we'll get through it, and we'll still get to that finish line on time, and won't have any issues. So that in a nutshell is that's a lot of information. You kind of drank from the hose on the basics of mortgage lending, on the basics of what your clients experience when they get pre-approved and when they come to a mortgage lender like Inspiro or anybody else. Know that we are always here for questions. Stop by, email, text, call. We'd love to talk to you. We'd love to establish relationships with each one of you and help you with your business. Do any of you have any questions before we sign off on anything we reviewed, any specific situation you're dealing with, any loan scenario, anything that I can answer for you while you've got me on the horn here. Okay, if not, just know that our doors are always open. Russ, we'll turn it back to you. I'll be sure to send Russ a copy of this presentation as soon as we get off. And you can reach out to him and he can get you a copy so that you don't have to take notes. You can have all those bullet points. And it was a real pleasure to see all of you. And we hope to see you more in the coming days and weeks as we work with you.
Awesome. Thanks, Christopher. Hey, and
Thanks.
for everyone, if you just did not put your first and last name into the chat box with your office in, if you'll just do that so I can check you off as having attended the class would be awesome. So anyway, that's it. Thanks for being here, guys. And thanks to you, Christopher, for all that you do. And you guys are awesome over there. So
Appreciate it, Russ.
okay, see ya.
Thanks, everyone.